Headlines blared. China dumps treasuries at record pace. This wasn't clickbait, it was a warning shot in the global financial order. For decades, China produced, America consumed, and China parked its earnings in U.S. Treasury bonds. This chimerical relationship kept U.S. interest rates low and funded American deficits. But that era is over. The collapse of this codependency is sending shockwaves through the world economy. When your largest foreign creditor starts selling your debt, it's a geopolitical message, not a market blip. For Americans, this could mean higher costs for mortgages and government services. This is the story of how financial codependency unraveled and what it means for the future. In global power games, we focus on aircraft carriers and missiles. But today, the real power plays happen on central bank balance sheets. A country's decision to buy or sell another's debt can destabilize governments and reshape alliances. No shots fired. China's massive U.S. debt holdings once stabilized the system and discouraged conflict. But as China sells, each billion is a thread cut in the web binding the two superpowers. This quiet decoupling reduces America's leverage over China, and vice versa. U.S. Treasuries are the foundation of the global financial system. When China treats them as a liability, it shakes the whole structure. This isn't a portfolio tweak, it's a strategic realignment. Beijing is signaling it no longer sees its future tied to America's financial health. To understand global power shifts, look at where central banks put their money, not what diplomats say. Capital flows reveal true intentions, immune to propaganda. The data is clear. China is building a financial fortress by selling U.S. debt. This action speaks louder than any military parade or naval drill. It's the silent, strategic language of a world on the brink of a new order. The real battleground is financial, not military. The world's second-largest economy is quietly rewriting the rules. The message, the era of American financial supremacy is under threat. Watch the money, not the missiles. Geopolitical strategy is often silent. True intentions are revealed by actions, not words. Where a nation invests its wealth shows its risk assessment and future vision. China's decades-long strategy was to integrate with the US-led system, buying trillions in US debt as a vote of confidence. But the recent sell-off signals a pivot from integration to insulation. Beijing now prioritizes security over returns, sovereignty over stability. Divesting from the dollar system reduces exposure to US sanctions and builds resilience. This is the economic equivalent of stockpiling military reserves. When a country sells your debt, it's a clear signal of lost confidence. For China, it's a preemptive defense against the weaponization of the dollar. The steady outflow from U.S. Treasuries is the most honest statement of Chinese policy. The era of cooperation is ending. Strategic competition has begun. The numbers tell the story. In 2013, China held $132 trillion in U.S. Treasuries, America's largest foreign creditor. Today, that's dropped below $700 billion, a $688 billion exit. This isn't a market drift, it's a deliberate, sustained campaign. China's sell-off has accelerated, with some of the sharpest drops in recent years. $688 billion is more than the annual output of Switzerland or Argentina. This is a superpower re-engineering its financial relationship with its rival. The pace is methodical, not panicked, a long-term plan, not a reaction. China avoids crashing the market, selling into strength and letting bonds mature. This soft exit minimizes self-harm while achieving geopolitical goals. The policy is consistent across U.S. administrations and economic cycles. Some analysts think the true sell-off is even larger, with hidden holdings offshore. The message, a massive quantifiable vote of no confidence. The numbers reveal a strategic withdrawal from the U.S. financial system. It's a $688 billion declaration that the old financial order is over. The world's economic map is being redrawn. The era of China as America's banker is finished. China's treasury sell-off didn't happen in isolation. It's a response to seismic geopolitical events. The US-China trade war in 2018 marked the end of cooperative engagement. Tariffs and confrontation made China's financial integration look like a vulnerability. The risk: US could weaponize China's assets, not just trade. The sell-off accelerated as China sought to reduce Washington's leverage. Then came Russia's invasion of Ukraine in 2022. The West froze $300 billion of Russia's reserves, a financial nuclear option. For China, the lesson was clear. Reserves in Western currencies could be seized overnight. Holding U.S. Treasuries became a strategic liability, not just an economic risk. The pace of China's sales jumped after Ukraine, turning de-risking into a national security imperative. Beijing is willing to pay the price to avoid leaving its economic jugular exposed. The cost of inaction, being vulnerable to U.S. pressure, is far greater. The world's financial rules can change overnight, and China is acting accordingly. China's sell-off is about de-risking, not chasing returns. The main goal: reduce dependency on a geopolitical rival and protect against economic coercion. U.S. sanctions on Iran, North Korea, and Russia convinced Beijing that its own assets could be targeted in a crisis, especially over Taiwan. By shrinking its U.S. holdings, China aims to neutralize the threat of asset freezes. It's about financial sovereignty, ensuring China's fate isn't dictated by Washington. There's also doubt about the long-term health of the U.S. economy and dollar, given ballooning debt and political gridlock. Diversifying away from U.S. debt is a rational hedge against a future crisis. Finally, selling Treasuries supports China's push to internationalize the renminbi and build an alternative financial system. The message: China is serious about ending America's exorbitant privilege. Where is China's capital going? Into hard assets, especially gold. The People's Bank of China has been stockpiling gold, a universal store of value immune to sanctions. Gold in China's own vaults can't be frozen by foreign powers. This is the ultimate de-risking move, building a financial war chest for turbulent times. Beyond gold, China is investing in critical commodities: lithium, cobalt, copper, and infrastructure worldwide. Through the Belt and Road Initiative, it's securing ports, railways, and energy assets. These are strategic moves to control supply chains and resources. The shift from financial to physical assets marks a new world view. Real control over resources trumps paper claims. China is betting that in a fractured world, hard assets offer true security. As China exits, who's buying U.S. debt? A new coalition: U.S. allies and financial safe havens. Japan, the UK, Belgium, Switzerland, and Canada have increased their holdings, filling the gap. On the surface, it looks like a vote of confidence, but this new creditor base is less stable. China's purchases were driven by economic logic. The new buyers have mixed motives: security ties, client demand, or safe haven needs. Japan, now the top holder, faces its own economic limits. Europe has fiscal pressures too. These buyers are more sensitive to interest rates and currency swings. Unlike China's long-term strategy, these investors can be fickle, ready to bolt if better opportunities arise or U.S. finances worsen. The U.S. bond market is now more dependent on allies' goodwill and the perception of America as a safe haven. That's a shakier foundation than before. If confidence falters or alliances shift, this coalition could disappear quickly. Unlike China's slow, methodical exit. The result? Potential spikes in U.S. interest rates and financial instability. The U.S. has traded a predictable, economically motivated creditor for a diverse but less reliable group. The system is now more fragile, not less. The world's financial safety net is thinner. The risks of a sudden crisis are higher than ever. The era of deep U.S.-China financial interdependence is over. China's Treasury exit confirms the split, forcing a rethink of financial security and global power. The U.S. faces higher borrowing costs and must attract new lenders with better yields. For investors, the lesson is clear: diversify globally and factor in geopolitical risk. U.S. Treasuries are no longer the unquestioned, risk-free asset. The world is splitting into rival financial blocks, with capital following new geopolitical lines. Globalization isn't dead, but it's more fragmented and competitive. Economics and national security are now inseparable. The comfortable assumptions of the past are gone. Vigilance and adaptability are essential. The challenge: manage the risks of decoupling and build a more resilient, if divided, global system.